My main theme is going to be the challenge that central banks face in communicating their monetary policies to ordinary households and businesses. And as educators, you know well the importance of communicating effectively and the difficulty of doing so. You also play a crucial role in the Federal Reserve's efforts to communicate with the American people. We central bankers are public servants, and we have a fundamental obligation to explain our policies clearly to all members of the public, whatever their level of economic knowledge. But our task is much, much easier when the public knows more about how the economy works. So I want to thank you for your contributions not only to training the next generation of economists, but also to helping all of your students become better informed about economics. Now, before discussing the challenge of communications, I'd like to review the current economic situation and how the Federal Reserve is setting monetary policy in response to it. Let me emphasize that all the views I expressed tonight are mine alone and not necessarily those of others at the Minneapolis Fed or elsewhere in the Federal Reserve System. So the Federal Reserve, as you know, conducts monetary policy to achieve two goals assigned by Congress: maximum employment and stable prices. And let's consider the current economic situation in light of those two goals. First, price stability. So the Fed's monetary policy arm, the FOMC, interprets this mandate to mean an inflation rate over the longer run of 2% as measured by the PCE price index. And I know you all know this, but it's something that we like to really emphasize because it's tough to get through to the public. This index includes the prices of all goods and services, including food and energy. So as this graph shows, inflation has fallen short of the FOMC's goal for more than 3 years. Now, some of the recent weakness is due to decline in oil prices, but we can strip those out by looking at core inflation, which excludes food and energy. And core inflation turns out to have been below target for almost all of the past 6 years. So this is pretty troublesome because inflation displays a great deal of inertia. So low core inflation today means that total inflation is likely to be low in the future. And the longer core inflation is low, the stronger this prediction is. So indeed, both private sector professional forecasters and the staff of the Federal Reserve Board expect PCE inflation to remain below 2% through 2017. And over the past year, financial market participants have also grown pessimistic about whether inflation will return to target. Here's a graph of market inflation expectations based on CPI swaps. So expected inflation 5 to 10 years from now. So that's expected inflation between 2020 and 2025, nothing to do with oil prices in 2015. But expected inflation 5 to 10 years from now has dropped by about 40 basis points since last summer. The FOMC's outlook, given all of these data, is that inflation will rise gradually toward the 2% target as the labor market improves and recent transitory influences, such as oil prices and the rise of the dollar, dissipate. So now let's consider the second goal, maximum employment. This goal is more challenging to quantify because of the many factors that affect the possible number of jobs in the economy at any time, and how those factors change in unpredictable and difficult to measure ways. So on employment, the FOMC looks at a variety of metrics to assess the economy's performance. In the interest of time, I'll just show you one, which I'm sure you're very familiar with, the unemployment rate. And as you can see, unemployment has fallen sharply from its peak in the recession. But other aspects of the labor market that we look at have not recovered nearly as much. For example, many more people than usual are involuntarily working in part-time jobs when what they want is full-time work. So the labor market data, taken as a whole, suggests that the economy still has room to recover. The FOMC has responded to the financial crisis and the ensuing recession by purchasing trillions of dollars in assets and by holding the federal funds rate near zero for an extraordinary period, 6 years and counting. So the FOMC is currently maintaining its asset holdings and is taking a data-dependent approach to setting the federal funds rate target. What that means is that in deciding how long to maintain the current rate, the current target range of 0 to 25 basis points, the committee plans to assess realized and expected progress toward those two objectives, inflation and employment. So now let me turn to my main subject, how central banks communicate about their policies. In recent years, with the federal funds rate stuck at the zero lower bound, the FOMC has relied increasingly on communications as a tool to influence the economy. This graph shows the number of words in the statements that the FOMC... So there are a lot of them, right? This is the number of words in the statements that the FOMC issues after its 8 times a year meetings. And in 2014, those statements were longer than ever, though they have become shorter this year. Now, much research has been devoted to the mechanics of traditional monetary policy tools, such as interest rates, but less to the mechanics of communications. This issue of communications is the subject of an essay that I wrote in the Minneapolis Fed's recently released 2014 annual report. I'm going to share some highlights tonight, and I hope I'll spark your interest in reading the entire essay. So the FOMC's recent communications have focused largely, though not entirely, on its expectations for the future course of interest rates and asset purchases. I'll argue tonight that this communications approach has been useful, but is incomplete. Describing the likely future path of policy, the roadmap, if you will, is clearly helpful in steering the economy. If families and businesses have a clear idea how interest rates will evolve, for example, they'll find it easier to make long-term decisions. But unless policymakers also communicate clearly about the economic goals they aim to achieve, what I'll call the destination, communications about the likely policy path alone leave the public more uncertain than it needs to be. So my argument is that effective communication requires more than a roadmap. It requires a destination. Now, why is that? When consumers decide how much to spend, or when businesses decide how much to invest and how many workers to hire, they have to figure out what they expect the economy to look like in the future, because these are all very long-lasting decisions they're making. But forming these kinds of expectations and forecasts is challenging even for professional economists who make it their full-time job. So how much more challenging it must be for an ordinary family or small business. If policymakers can directly provide some idea of where the overall economy is headed, the public can form much more accurate beliefs. Of course, policymakers can't perfectly forecast the future, so they can't promise that a certain inflation rate or a certain level of unemployment will be achieved in a given year. Nonetheless, they can say what they're trying to do. If all goes according to plan, in what year do they intend to bring inflation back to the FOMC's 2% target? What labor market conditions do they expect to prevail at that time? The situation is like that of a bus company that's issuing a schedule for trips from Minneapolis to Chicago. The company has to provide at least a basic roadmap. The bus is going to stop in Rochester and Madison, so passengers know where they can get on the bus. But the company can't commit to an exact map to drive through downtown on a particular street, because there might be traffic jams or construction projects that would mean the driver has to pick a slightly different route. But what passengers really want to know is that this bus is heading to Chicago and that's going to arrive there at such and such a time. And this is something the company can't forecast perfectly, but it can still give a simple answer to the passenger's question. We aim to get this bus to Chicago by 9 p.m. So similarly, central bank policymakers will be most effective if they communicate clearly not only what they intend to do, but also what they intend to achieve, the destination as well as the path. So in the remainder of this talk, I'll review some basics of how communication about roadmaps and destinations can help achieve monetary policy goals. I'll then discuss how the FOMC has actually communicated in recent years. And finally, I'll explain how that recent experience demonstrates the importance of communicating about a destination, and I'll describe one way that Federal Reserve communications might be improved. So the purpose of monetary policy communications is to influence the expectations of households and businesses. In fact, as Federal Reserve Board Chair Janet Yellen has emphasized, all monetary policy tools work in large part by influencing expectations. For example, a change in the overnight federal funds rate has an impact mainly because a change in today's rate alters expectations about the path of rates well into the future. Even if the Fed did not communicate at all, its actions alone might influence expectations because the public could learn from patterns in the Fed's historical behavior, but communication enhances policymakers' ability to move expectations. Now, plans for the future are subject to uncertainty because many different shocks can hit the economy. Policymakers have to account in some way for this uncertainty. In particular, they can't give a complete roadmap for their future actions, a fixed time path of interest rates, for example, because they'll need to make adjustments in response to shocks. If inflationary shocks hit, the FOMC may need to raise the path of interest rates. If demand falls, the committee may need to lower the path of interest rates. A policy path that will achieve good results in one possible future will be undesirable in other possible futures. Now, at the same time, because so many shocks are possible, there's no way for policymakers to lay out a contingent plan for responding to every conceivable shock. So let's take ourselves back to 2001. At its August 21st meeting that year, the FOMC could not possibly have contemplated that the United States would come under a terrorist attack within 3 weeks, let alone developed and announced a contingent plan for a monetary policy response to such an attack if it were to happen. But nonetheless, there was a terrorist attack, and on September 17th, the FOMC responded by reducing the federal funds rate. So was there a way for the public to know, even before the tragedy of September 11th, that the Federal Reserve would respond appropriately if an unanticipated bad shock were to occur? In many theoretical models, monetary policymakers have no need to communicate to solve this problem. The public is assumed to know policymakers' goals and is assumed to rationally expect that policymakers will act as appropriate to achieve those goals, whatever shocks may come. So in these models, families and firms can put themselves in the shoes of policymakers, work out what choices the policymakers will make in any conceivable future, and thereby know the entire contingent plan, even though policymakers never announce it. So to say this is to say how strong an assumption this is. In practice, making policymakers' goals sufficiently clear is exactly the difficulty. The Federal Reserve Act lays out the dual mandate for monetary policy that I showed you, but it doesn't define maximum employment and it doesn't define stable prices. It wasn't until 2012, some 35 years after Congress passed the dual mandate, that the FOMC gave a quantitative interpretation to price stability, a 2% inflation rate. But even then, the FOMC did not say how far or how long it would allow the economy to deviate from that target. And it went on to add that it couldn't provide a fixed quantitative goal at all for the employment mandate. So the public has to work very hard to infer what policymakers are trying to achieve and, therefore, how they are likely to act. The public's lack of complete information about policymakers' goals means that if policymakers communicate only about their planned actions, about their roadmap, they force the public to guess how they will react to shocks that the plan doesn't contemplate. By contrast, if policymakers also make clear the destination they're trying to reach, acknowledging, of course, that some shocks may prevent reaching it, then the public can better infer how policy will respond to any shock. Now, why care whether the public knows how policy will respond to shocks? First, conveying this knowledge is how policymakers move expectations and influence the economy. Second, if the FOMC is going to achieve the goal of maximum employment, it must avoid creating unnecessary drags on economic activity. Uncertainty about how the FOMC itself will behave is one such drag, because households and firms will typically act more cautiously, saving more and spending and investing less, if they have more doubts about the future. Now, importantly, the best way to provide certainty about policy is not to establish a fixed policy that will not respond to shocks. Such a policy would be certain, but it would be certainly inappropriate. Policy needs to react appropriately to shocks, and the certainty that policymakers must provide is about the nature of that reaction. Given the vast variety of possible shocks, communicating about the desired destination is an efficient way to explain how policy will react. Now, the FOMC continually emphasizes this idea that policy will react to shocks, that the policy depends on how the economy evolves. And this data dependence, as I've said, is crucial for effective policymaking, but challenging to communicate, because how is the FOMC going to concisely explain its potential reaction to each shock that might hit? The FOMC's recent response to that challenge has been to focus instead on the likely path of its policy instruments, what's come to be known as forward guidance. The FOMC's recent forward guidance has mainly come in two forms, what we call calendar-based and state-based. Calendar-based guidance talks about deploying interest rates or asset purchases for a particular period of time. So the FOMC might say, we're going to maintain the current target range for the federal funds rate until late 2013. That would be calendar-based forward guidance. State-based guidance, by contrast, talks about deploying interest rates or asset purchases until a particular state of the economy occurs. For example, the FOMC might say we're going to maintain our current target for the funds rate at least until the unemployment rate reaches 6.5%, assuming that inflation doesn't get too high. That would be state-based guidance. Now, relative to calendar-based guidance, state-based guidance can give a bit of a better sense of how the Fed's policies depend on the data, at least to the extent that this guidance is clearly communicated and the public interprets it correctly. And so all of this forward guidance has a lot of valuable benefits, but it's not ideal. Describing the likely path of policy instruments is extremely helpful for financial market participants. They can have billions of dollars riding on whether interest rates will change in one month or another. So they would love to know in what month will rates change. And if you're an economist or a financial analyst who's well-versed in Fed speak, You might even be able to read between the lines of an interest rate forecast and infer how the FOMC will behave in some other scenarios. But forward guidance about policy instruments is of limited benefit for helping ordinary households and businesses understand where the economy is headed. A forecast for the path of the federal funds rate doesn't say what households and businesses should expect for the variables that matter most to their decisions. Variables like prices, wages, the chance of finding a job, the likely demand for their products. In other words, forward guidance emphasizes the roadmap for policy tools, but doesn't tell us the economic destination. One pitfall of providing a roadmap without a destination is that the public might misinterpret a midway stop as the ultimate destination. And we had an example of this in 2013. So in December 2012, the FOMC said it would keep interest rates effectively at 0%, at least until the unemployment rate reached 6.5%. And this unemployment number was intended as a threshold, a line that had to be crossed before the committee would even consider raising rates, assuming inflation remained under control. But some FOMC participants at the time voiced concerns that the public would mistakenly view 6.5% as a trigger that would result in automatic rate increases. These two interpretations, threshold and trigger, imply significantly different economic destinations. If 6.5% unemployment is a trigger for rate increases, the FOMC must not be aiming for unemployment much below 6.5%. But if 6.5% unemployment is just a threshold for considering rate increases, the goal could be a much lower unemployment rate. The difference between those destinations could matter greatly for households and businesses. Just how vibrant should they expect the economy to be? By making the number 6.5% very prominent in its communications, without pinpointing its actual goal, the FOMC ran the risk that the public would mistake 6.5% for the goal and form expectations predicated on that mistake. Now, there are two major exceptions to the FOMC's recent focus on roadmaps. These exceptions show both the benefits of providing a destination and the importance of explaining that destination clearly. The first exception is the 2012 announcement that price stability means a 2% inflation rate. This announcement freed the public from the need to guess what inflation rate the FOMC is aiming for. It plays a crucial role in anchoring inflation expectations at 2%, even as realized inflation data continue to run below that target. But at the same time, it's far from being a complete destination. As the Minneapolis Fed's president, Narayana Kocherlakota, has said, the public needs to know not only what inflation rate the Fed is aiming for, but also how quickly the Fed aims to get there. Households and businesses will make quite different decisions if they expect inflation to creep back to 2% over the next decade than if they expect the target to be attained next year. The second exception is the expanded asset purchase program that the FOMC began in September of 2012. In launching that program, the committee said, if the outlook for the labor market does not improve substantially, the committee will continue its purchases and employ its other policy tools as appropriate until such improvement is achieved in a context of price stability. So this program involved not only a roadmap, buying assets at a pace of $85 billion a month, but also a destination, a substantially improved outlook for the labor market. But this destination was not very precise. What indicators would represent substantial improvement in the labor market outlook? How rapidly did the FOMC intend to reach that goal? When the FOMC began to give more specifics in the spring of 2013, financial markets reacted by sharply driving up bond yields in what is now known as the taper tantrum. Market participants appear to view the rising long-term interest rates as likely to reduce economic growth. So in other words, markets viewed the FOMC's announcements about the details of its plans as revealing that the FOMC had changed the economic destination, had changed the amount of growth it was aiming for. But policymakers actually did not intend any kind of negative reaction, and they had to work hard after that to persuade the country that they had not changed their goals. Now, some people have viewed the taper tantrum as demonstrating that communications about the destination of monetary policy lead to undesirable volatility. I take the opposite lesson. The mismatch between public and FOMC expectations happened because the committee described the destination only vaguely. Markets became volatile when the committee surprised the public with its choice of a more precise destination. So to return to the image of buses, it's as if a bus left New York with an announcement that it was headed for the West Coast, and the passengers got on this bus expecting to go to San Francisco. And then when the bus got to Salt Lake City, the driver turned south and drove to Los Angeles. Still the West Coast, but not what the passengers were expecting. So of course these poor passengers would be surprised. If the destination had been clear from the outset, So in the asset purchase program, if the FOMC had said it was using asset purchases to bring unemployment down to 7% within a year, for example, much confusion could have been avoided. So having critiqued the FOMC's communications, let me close with some constructive suggestions. Staff here at the Minneapolis Fed have experimented with alternative ways of writing the FOMC's post-meeting statements to communicate more effectively. It turns out that there's quite a simple solution. So I'll give an example based on the FOMC's January 28, 2015 statement. I'm going to take the policy decision that's embedded in that statement as given. So I'm just commenting on how the statement functions as a communications tool. So here's what that statement looks like, or part of it, what I could fit on a slide. And it begins with 2 paragraphs describing recent economic developments and the committee's economic outlook. After this long preamble, the statement lays out a roadmap for the federal funds rate and for asset purchases, and it states that the rate will be data dependent. A key part of the roadmap is that the FOMC says in this January statement, it's not what it's saying anymore, but what it said in January, that it would be patient in beginning to normalize the stance of monetary policy. The FOMC also used the word patient in December 2014, and at the time, Chair Yellen translated this word patient as indicating that the committee was not likely to raise interest rates for at least the next 2 meetings. So by repeating the word patient in January 2015, the committee extended by 1 meeting the period when it was not likely to raise interest rates. Okay, so this statement has a couple of weaknesses from the standpoint of communications. I said I was done critiquing, but I'm not quite. So first, as journalists would say, it buries the lead. The public has to read through this long preamble, and then it has to translate the word patient to find out what the policy action is. Now, the second weakness is that the statement never explicitly says what economic destination the FOMC is trying to achieve with this policy action of delaying by 1 meeting the time when it's not likely to raise rates. So these weaknesses are easily fixed. Here's an alternative statement that was drafted by staff at the Minneapolis Fed that aims to convey the very same policy decision. Let me emphasize that this experimental alternative is just an idea from some staff at the Minneapolis Fed, and it in no way represents anything you should expect to see the FOMC issue at any upcoming meeting. So the alternative statement begins with a simple summary of the day's policy action and what destination it's expected to achieve. So no buried lead, explicit destination. Was that so hard? Now, the description of the destination, I had to do a little work to figure out how we could produce this, but it draws on forecasts that FOMC participants already put out in the summary of economic projections of likely economic outcomes under appropriate monetary policy. So people are already thinking about the destination. This is about saying it. The alternative then gives details on the policy roadmap. It's not that roadmaps are useful. We still need to talk about them. And this roadmap avoids using patient as a code word. And it just says that the committee is unlikely to raise rates at its next 2 meetings. Finally, to help make the destination credible, the experimental alternative explains why the FOMC believes that the roadmap will lead to the destination. It's not enough to announce a destination. You have to persuade people you will get there, and drawing the link between your policies and your destination is one good way to do that. So monetary policymakers in other times and places have also communicated effectively about their destinations. For example, in 2012, as a sovereign debt crisis threatened the stability of the euro, European Central Bank President Mario Draghi said, "Within our mandate, the ECB is ready to do whatever it takes to preserve the euro, and believe me, it will be enough." Now, President Draghi did not say what it would involve, but this clear statement about the ECB's destination, preserving the euro, proved to be effective at increasing confidence that that destination would indeed be achieved. However, communication about the destination need not be a tool employed only in extraordinary circumstances. It might be tempting to think that because the Federal Reserve achieved good results for the 2 decades before the financial crisis without communicating about its destination, such communication will again be superfluous now that the recovery is well underway. But if the FOMC does not communicate its goals, the public has to infer those goals from the FOMC's actions. In the stable economic environment that existed before the crisis, such inferences were relatively easy. Today, by contrast, policymakers and the public face an unusual degree of uncertainty about economic fundamentals. So even in good times, which after many years of recovery, 2015 may finally bring, explaining both the policy roadmap and the destination can help better align public expectations with policymakers' goals. Thank you very much for your attention. I'll be happy to answer any questions.
Hi, I'm Martha Only from UC Berkeley. So when you all talk about expectations, presumably you're talking about this well-anchored inflationary expectations piece. And the question is, whose expectations do you care about? So you could care about the expectations of households. You could care about the expectations of business people. You could care about the New York Times reporter, because nobody reads the statements except for those of us who teach. So
That's more than I thought.
Yeah. So I think I guess I have two questions. One is, whose expectations do you care about? And I like your alternative statement, but who do you think is going to read this statement or the alternative statement? Yeah, and why do you care about whoever's expectations you care about?
This is a fantastic question, right? The key in communications is always who's your audience, right, and who are you trying to communicate to? So I'll just share my personal views on this. The current way that we communicate is quite opaque. You've got to be a Fed watcher. You've got to be an expert to make sense of it. Now, there are people in financial markets who are highly incentivized to be able to understand whatever the Fed communicates. And so the mechanism by which we're influencing the economy is we influence that set of people.
But why do we care about that?
So that's where I'm going.
Okay.
Right, so those folks then influence prices in financial markets and interest rates. And those changes in interest rates are then transmitted to people in the economy who face these interest rates and make decisions based on them. So that's one way that you could work. My argument here is we're trying to influence the behavior of agents throughout the economy, households, businesses, and these people in financial markets, and this reporter in the New York Times who's going to write a story that people will read. We're trying to influence everyone. And so our audience has to be as broad as we can make it. We shouldn't rely on a bunch of intermediaries through how they change interest rates, through how they write the newspaper story, convey a message to whoever it is we're trying to communicate. We should come out and say it in a way that's understandable by everyone or as many people as can. Now, that's my personal view.
But do you care about what the households think because you believe real interest rates is what we respond to? Or do you care about what the households think because of political issues? Why do you care what I think if I'm a person?
So say the Fed is trying to stimulate the economy. Say we're trying to increase economic activity. So I want to get you in particular to spend more money. Right? So I care about what you think, because if I can induce expectations in you that cause you to spend more money, that'll help achieve my goal.
Okay, so you think I respond to real interest rates?
Well, or you may respond to real interest rates. You may respond to just beliefs about what the future is going to look like, right? So if you're thinking, it's going to be easy to get a job whenever I want a job, and therefore I don't have to do so much precautionary saving, and so I'll spend some money. So it's not just real interest rates, but it's everything you believe about the future might influence your behavior.
Hi, everybody. Thanks for a very nice speech. My name is Alfredo Baldini. I'm from the IMF, actually in Washington, so we're very close to the Fed and their statement. I wonder if the publication of the minutes has greatly enhanced the communication. Do you think is an enhancer, or is it might come into conflict? Can you elaborate on that? If it was a positive innovation or not?
So I'm in favor of transparency at central banks, and the minutes come out several weeks after the FOMC meeting and go into much greater detail than the statement about what was discussed. And so you sometimes see minority perspectives described in the minutes. You see more of the reasoning behind what was discussed. You see issues that didn't rise to the level of needing to be mentioned in the statement. You see what the committee is thinking about those. So I think it's fantastic that in a democracy we're able to share with the public as much as we can about how we're making decisions. So I think the minutes are great from that perspective. Right? But what the minutes are is a record in chronological order of what went on in the meeting. Right? So the minutes are not a communications tool that in itself is intended to convey what the policy action is or influence expectations of anyone in the economy. Right? The minutes are a way to provide transparency about what we're up to. Right? If we want to use communications as a tool, we have to have separate tools for doing that.
Hi, I'm Galit Eisman, and I have two questions. First, aren't we teaching or studying that actually surprising the public and not letting them know the policy would actually make more influence or would impact more their behavior and expectations? So we should kind of like surprise them or hide the policy from them. And the second question is, do the policymakers themselves know where they're going in your bus illustration? I mean, are they, or it's kind of like random in terms of like what they are, what they do after any shock? Thank you.
Wow, great questions. So first I'll take the second one. So I'm not allowed to describe what any policymaker thinks. So I'll just say that my view is that policymakers should know where they intend to go and should tell us about that. Going back to the first question, is the way monetary policy works that we surprise the public? It's true that a one-off surprise could be very powerful, but you can't use that over and over, because if what the public thinks is that you're trying to trick them, this will be very damaging to the economy. So one-off surprises are powerful, but in the long run in equilibrium, that can't be how you use monetary policy.
Hi, my name is Evan Tanner. I'm also from the IMF. So I am definitely in favor of your idea of using clear English and to convey not only the views, but also the uncertainty that policymakers have about those views. And in response to, what was your name, Angelica's question? Okay, about do they know where they're going? Sometimes I suspect that these minutes sort of show some ambiguity, that they're grappling with issues, but that may be okay. But my question is that some have suggested that in addition to clear English that gets the nuance, we could do a quantitative supplement by providing fan charts, not only of the sort of the endogenous variables, but also the policy variables themselves. And some might criticize that and say, well, this is too technical for the man on the street, but I suspect that it would just give us economics educators a little bit more to put on our plate here, some more interesting topics, and people learn. And you know, the FT is doing fan charts of debt now, so anyway.
Yeah, so many other central banks besides the Fed do include all kinds of fan charts in their monetary policy reports. For example, the Bank of England and a number of the Scandinavian central banks do this. And so this is a very powerful tool for communicating, because it means that you don't just have to use words, you could use images, and some people are visual thinkers. And so this is a way to get through to people for whom words is not the best way to communicate. So if there's a project of improving communication, certainly using tools other than words is a great idea. From the education perspective, you're not limited in teaching your students about how monetary policy works to showing what the Fed does. Right? So I think there are lots of interesting examples of communication from other central banks around the world that often have quite similar objectives to the Fed. So you can talk about it within the same framework that the Fed operates, but you can show how do they make a decision, how do they explain a decision. Here is the fan chart where they show their uncertainty. So there could be some nice teaching tools there from around the world.
Question for you. I'm thinking about this as a teacher, and things come up also as a parent. We do things and we want to try to maintain credibility, and that's one big thing the Fed tries to do, right, is maintain credibility. And as a teacher and as a parent, a lot of times it's good to be vague when you want to maintain credibility, because you feel like you have more flexibility. So isn't there some risk with this that if you're very clear and specific, and then the public expects, okay, they won't do anything for 2 months, but then there's a big shock and they do things, has the Fed lost credibility that they didn't have to?
Yeah, so great question. Credibility is obviously crucial, and this is another reason why talking about the goal you're trying to reach rather than what you're going to do with your tools can help. Right? So if you say, I'm going to keep interest rates at a certain level for the next 6 months, you've got a problem if a shock hits that makes you want to change that plan. If what you've said is, I'm going to do my best to keep inflation within 25 basis points of the target, then if a big inflationary shock hits, people will understand that you must be planning to react to that, because what you've said is you're going to keep inflation near the target, not you're going to do a certain thing with interest rates. Right? Now the problem is, what if shocks are such that you can't achieve the goals you announced? Right? So what if you've said, oh, you're going to do your best to keep inflation within 25 basis points of the target, and then there's a huge oil price shock that's so big that you can't do anything about it without causing a huge recession, which you don't want to do. So when you're talking about your goals, you have to explain that there are going to be things that could happen that prevent you from achieving them. Right? And this is no different from when you talk about goals with students, with children, in a corporate context with employees. You always have to be clear that no goal is set in stone, whatever happens. Right? And it's helpful to explain what might get in the way of that. If you don't do that, you are going to lose credibility. So explaining that is important. But by and large, I think talking about the goals rather than the tools will help with this problem.
As a thought experiment, would you consider opening a Twitter account and expressing that in 140 characters or less?
I think it's a great idea. The reality of it is the committee as a whole agrees on the statement. So the committee would have to open the Twitter account and agree on the 140 characters. I'm not free to tweet my 140 character version of the FOMC statement.
I'm Michael Salemi, University of North Carolina. You just touched on something here, which is the focus of my question. This is a statement by a committee, many people, and yet you analyze it ex post as if it were a statement by one person, and you show it could be more clear. But we know from, for example, Supreme Court statements that the ambiguity is often a political way of reconciling differences that the justices were not prepared to meet head on and reach clear language on. And I wonder, I'm not criticizing you for this, but I'm wondering how you, in your own view of this preferred communication style, you reflect on the fact that it's people rather than a person.
Yeah, so it's certainly the fact that it's people and they've got to reach an agreement and they compromise on lots of things makes it very challenging for the committee to communicate. This shows up in the statement. It shows up in the fact that committee participants go around and give speeches and they share their views. And those are individual views, and then the public has to figure out how those add up to some kind of committee decision. It shows up in lots of places. It's still helpful to lay out what would really good communication look like. So we have a benchmark, right? And then people can weigh that against the benefits of being vague. But if we don't have a benchmark of what would really good communication be, then people can choose to be vague without an appreciation of what the costs of vagueness are. So it's helpful to aspire to really good communication, even if there are structural impediments.
But of course, if we went through the process of, say, preliminarily the FOMC drafted a statement and then passed it through you, and you homogenized it, as it were, and produced this document, which was clear, and returned it to them, that none of them might approve of it.
It's who knows.
I'm Sue Stockley from Eastern New Mexico University, and I just wanted to ask, who else in the Federal Reserve System is thinking this way, or is Minnesota kind of a rogue?
I don't want to speak for folks at other banks. So, there's certainly a lot of people who are sympathetic to clear communications, and there are also people who are sympathetic to the view that vagueness is helpful and allows us to be artful about things that are hard to express. But I'll let other people speak for themselves on that.
Hi, my name is Chris Wright, and I'll try to keep it simple. I appreciate the woman in your initial questions about you're trying to, in my words, come up with a clearer, more efficient way to try to influence expectations. Is that correct? Am I with the idea? My follow-up then is, it goes back to this idea. I find myself thinking, I'm going to just try to cut to the chase. Are my consumers, are they not behaving the way the Fed would like them to be behaving right now? What is it that you want different? I appreciate what you're saying. We want to influence the expectations, and I think her question was sort of, what do you want to accomplish by doing that? What is it? And I've never heard the Fed, for example, say, we want consumers spending more. But do you see what I'm trying to? What's the purpose for trying to get these expectations formed?
Yeah, so the Fed actually does say things that if you translate them are, we want consumers spending more. Right, so the Fed will say we're taking this action to put downward pressure on longer run interest rates, which we expect will support the housing market. Translation: buy more houses. Right, and so the Fed does say things like that, and those are the goals. An example of a situation where it didn't work so well would be the taper tantrum. Right, so the Fed had an intention for what kind of economic growth it wanted to produce. It was accomplishing that in large part through asset purchases, which were intended to push down longer-term rates and, in particular, support the housing market, among other markets. Then the Fed started communicating more details of how it was going to do those asset purchases and some testimony by Chairman Bernanke and in a press conference. And suddenly interest rates went way up, mortgage rates went way up, and there were appreciable effects on real activity, on things like the housing market from that were not desired. Right? So that was an instance where the communication didn't work as intended. Right? And by being clearer about what are we trying to achieve, we can avoid those kind of problems.
Can I just follow up real quick? There's something going on out there that might that be the tail wagging the dog though a bit. You know what I'm trying to ask? I mean, is the Fed now finding itself having to respond to these, to what you just called sort of this unexpected market reaction because they misunderstood us? And so do you see what I'm trying? Things are getting a little circular in your policy, is it not? Or you don't agree?
No, I think the story here is, as we discussed, a lot of what the Fed does is communicate to financial market participants who move interest rates. If you have an episode where that didn't work as intended, you've got to do something else to get the interest rates to go where you were trying to move them. So that's how I interpret the taper tantrum, is that the communication didn't work as intended and could have gone better.
Hi, Roisin O'Sullivan, Smith College. In your opening slide, you explained that the Fed has a dual mandate. And you're talking about the importance of communicating the destination. So how should we as educators communicate to our students how you weigh the two parts of that mandate? So if you look at recent history, in 2012, you announced an explicit inflation target, but then policy seems to be much more focused on maximum employment recently, and especially with Chairman Yellen coming in and the measures of labor market slack, etc., one could be forgiven for thinking that unemployment is now much more important than inflation. How do we explain to our students the state contingent decision about how those goals are weighed?
Another fantastic question, and this goes to, again, how can the Fed communicate what it is trying to achieve? Right? And what the Fed is trying to achieve is two things at once. Sometimes those goals are not in conflict at all. So right now, most economists think that employment could be higher than it is, and inflation is also clearly below the 2% target. Most policies that would raise employment would also raise inflation. And so we can do better on both goals at once by making certain policy choices. Right now, there might be other reasons why we don't want to make those choices. Right? For example, people have argued that further stimulus would lead to financial instability. But at least in terms of those two goals, right now they don't appear to be in conflict. Right? There are other times when the configuration of shocks is such that there is a conflict and you've got to decide. But the first thing for students to understand is that these goals are not always in conflict. Right? So sometimes it doesn't matter. Right? If the Fed were purely an inflation targeter, it would make roughly the same choices now as if it had a dual mandate. Because both being a pure inflation targeter and having a dual mandate suggest that there should be a lot of economic stimulus right now. The times where it matters is when inflation is high and employment is low. Right? Or then you might say, well, what about when inflation is low and employment is high? My personal take on this is if inflation is low, it's hard to say what it means to have employment too high. Could there really be too many jobs? Right? Yeah, you could argue, well, there are people who want a vacation and just can't have one. But it doesn't seem like a huge problem to me, right? So the combinations of where inflation can be and where employment can be, the only one where there's actually a conflict between these is when inflation is high and employment is low. Most of the rest of the time, they're not in conflict. Right? Then the Fed does have to explain in these times when the two goals point in opposite directions how it's making that choice. Right? And that really relies on the committee when it faces that difficult choice explaining what it's up to. a traditional view in a lot of the Fed has been that in the long run, the best thing the Fed can do for employment is to have stable inflation, right? That in the long run, unstable inflation could be very damaging to employment. And so from that perspective, there's not a conflict between these goals, even when inflation is high and employment is low. Because if you were to not pay attention to inflation for very long, you would do serious damage to the economy. So that's one view people have taken, but it's certainly not the only view. There are others who argue that it's appropriate to tolerate higher inflation for a while in order to get employment up.
I think we have time for one last question.
Hi, thank you for your comments very much. So one question that I have is that it seems that the Fed's comments don't just serve the purpose of telling people what the Fed is going to do, but also what the Fed thinks is going on in the economy right now. So I wonder if there's additional strategy that enters into the kind of statements that you want to make, thinking about how people are going to react on that dimension as well.
So I guess it's certainly true that the Fed talks about what it thinks is going on in the economy in its statements. I view this as being about fundamental transparency. Right? The public has given the Fed an enormous amount of authority, and the Fed also has an enormous amount of leeway relative to most other public institutions to operate behind closed doors. And we think that freedom and opportunity to be behind closed doors is crucial to success in monetary policy, but it's also really important not to misuse it. Right? And so this is a democracy, and we have to explain to the public who we work for what we're thinking about. So that's why I think it's really important that information is in there. Others might view it differently, but I think this is just about being transparent with the people we work for. Well, thank you very much.